What I have for you this week is a little different than normal case law. It is a discussion of the July 2022 progress report on Pillar 1 and the legislation, the proposed legislation that came with it. Now, I'm going to try and use this on a practical example, but there's no guarantee that this is right. First, I know very little about the company that I discuss, and second, the legislation comes with no extra guidance. But let's give it a try because I think it does put the legislation into perspective. So we're looking at Facebook. We're looking at the 2020 annual accounts of Facebook, and here you can see that in that year they made almost 86 billion euros in dollars in turnover. That is way above the $20 billion threshold. And if you look at their net income before taxes, that is 33 billion, which is almost 30%, which is more than 30% of their gross revenue. So they definitely are also way above the 10% threshold for routine profit. If we look at the description of what Facebook says they are doing, they say we're doing advertising. We generate substantially all our revenue from advertising. Our advertising revenue is generated by displaying ad products on Facebook, as we all know, Instagram, Messenger, and third-party affiliate websites and mobile applications. Marketers pay for ad products either directly or through their relationships with advertising agencies or resellers based on the number of impressions delivered. We recognize revenue from the display of impression-based ads in the contracted period in which impressions are delivered. Impressions are considered delivered when an ad is displayed to a user. Now, again, we use Facebook, many of us, every day, so we know what is going on here. We recognize revenue from the delivery of action-based ads in the period in which a user takes action, the action the marketer contracted for it. The number of ads we show is subject to methodological changes as we continue to evolve our ad business and structure for ad products. In other words, all the algorithms that make sure that they target you more and more precisely, right? We calculate price per ad as total ad revenue divided by the number of ads delivered, representing the effective price paid per impression by a marketeer, regardless of the desired objective, such as impression or action. For advertising revenues, arrangements where we were not the principal, we recognize on a revenue on a net basis. And then we have other revenue. Other revenue consists of revenue from delivering of consumer hardware devices, and now we're talking about delivery of goods, net fees we receive from developers using our payment infrastructure, and revenues from various other sources. So we have an idea of what they're earning and what they're doing, but remember there were also outcry about Facebook selling data, personal data, to third parties. And I do not see that in this in the summary here, but there is a reference to it later in fines. I also want to look at the Danish Facebook company, because obviously, I mean, if there is a company in Denmark already, the question is to what extent Pillar 1 will apply. And we've got here Facebook Denmark APS. If you look at their comment on revenue, they say that the revenue is the value of principal services applied, and you can see here they mention only 69 million in kroners in their financial statement, but then in the notes they say the 69 million is actually broken down, as you can see here at the bottom, on gross revenue of 936 million minus cost of sales of 866. And obviously we don't know what is in those cost of sales, whether those are purely third-party transactions or primarily intercompany transactions. Facebook Denmark describes its activity as the principal activity of Facebook Denmark APS is the provision of sales support and marketing services to the Facebook group, and to act as a reseller of advertising services to designated Danish customers. Again, no split of that income. I don't know whether we should qualify Facebook Denmark as a pure service provider or the activities in Denmark as pure service providing activities. The question is whether that even matters, right? Because I think it is, when we look at allocating income to a particular region, it is what the group does, not what the particular country does, as Pillar 1 also applies when you don't even have anyone in a particular country. Just to turn this into dollars, 936 million kroners comes to about $133 million, which is 0.7% of the total global turnover. So Denmark is a very small market on the map, but still it is way above the 1 million euro threshold for having Nexus in Denmark, which if we look at these numbers. So what do I expect? I expect we're going to have a Facebook group in the US and a Facebook group in Denmark, and then we're going to have amount A allocated to Denmark, provided that amount A is more than the income reported in Facebook Denmark already, right? So the expected process will find the global marketing profit for Facebook in Denmark, which will be the EBT minus 10% of the group revenue, multiplied by 25%, right? So we get the marketing profit. And then we're going to have to find the marketing profit allocable to Denmark, which means we need to find the income that is allocable to Denmark based on the activities of Facebook. And then we need to deduct the income that's already taxed in Denmark. Otherwise, you tax that income twice. We need to calculate any active income deductions that Facebook may have in Denmark. And then we need to assume that there's no funny business. Facebook is not in the extraction business. They're not in banking. They're not doing any mergers in 2020 or splits or acquisitions for that matter. And we need to determine the tax due on the income allocable to Denmark, because that is ultimately the object of the exercise. How much can Denmark tax? But obviously they would have to give some kind of double tax relief for the tax that Facebook pays in Denmark already. So let us dive into the legislation from here. To do that, we would need to see what the rules say, and I will take a bit of a sledgehammer approach in doing this, otherwise this video will take days. So I'm going to take an approach where we start at the back end of the formula and then we work our way back to see what we need to do. So Article 6 says how we need to allocate profit. And it says the relevant portion of the adjusted profit before tax of a covered group, and we see that Facebook is covered, is taxable in Denmark for a period. That amount is equal to the amount of profit allocated under the formula set out in paragraph 2, which we'll look at a moment, reduced where applicable by the adjustment set out in paragraph 3, and that or 0, whichever is higher, right? So we need to see what paragraph 2 says, and then we'll look at paragraph 3. And paragraph 2 has an introduction, and then it gives you the formula, and it says in algebraic form, the formula is Q equals P minus R times 10% multiplied by 25% multiplied by L over R, where Q is the amount of profit of the covered group allocated to Denmark. P is the adjusted profit before tax, so we're going to have to calculate this one first. R is the revenue of the covered group. 10% is profitability threshold, so it needs to be more than routine profit, which is 10%. 25% is the reallocation, so whatever is more profit there is more than 10%. 25% is deemed to be generated by local marketing intangibles, and then L is the amount of revenues of the covered group for a period that arise in Denmark. So it's this 940 million kroners that we looked at before, right? But let us start by focusing on P. And P says determination of the adjusted profit before tax of a group. For the purpose of this act, paragraph 1, the adjusted profit before tax is the financial accounting profit or loss of a covered group after making the adjustments set out in paragraph 2 and deducting any net losses according to paragraph 3. So this is an endless rolling formula going forward and forward and forward, right? And if we look at the financial accounting profit, which is adjusted, it is first adjusted for tax expenses. Obviously, you add tax back. You exclude dividends because that is not really, that's just group income. You exclude equity gains and losses, more or less the same issue. And then you disallow, you add back any disallowed expenses such as penalties and fines. You make the corrections for prior periods, as we also saw in Pillar 2. You don't fix the year in which you made the mistake, you fix the year in which you discover the mistake, right? And then you need to take out the excluded entities, those in the extractive industries and those in banking, for instance. You need to revalue your assets with regard to impairments and stuff like that. And then you need to do a number of other accounting-based adjustments. So let's dive into this when we look at what tax expense is. It's a pretty obvious one, but for instance, does it also include deferred taxes and issues like that? So Title 7, as it's shown here, gives you definitions, and the definitions included in this title apply for the purpose of this act and its schedules, unless explicitly stated otherwise. And then definition 22 defines tax expense or tax income. And it says it means the income tax and it includes current and deferred income tax expenses, but it does not include interest charges for late payments of tax, right? And if we look at Facebook, the parents' accounts, we can see that this is note 15 on income taxes. It has both domestic and foreign taxes, which is also the idea. And it has, as you can see from the bottom part of the calculation, it also has current and deferred taxes for the year. And that comes to $4.340 billion. So this will be the amount that we will be looking at. And we can fill that in as a part of our tax expense and adjustment that we need to make to the financial accounting profit of the group. Our next adjustment we need to look at are excluded dividends. And again, if we go to Title 7 about definitions, then paragraph 18 says excluded dividends means dividends included in financial accounting profit of the covered group under an acceptable financial accounting standard that are received or accrued in respect of an ownership interest, right? That is a pretty understandable definition of dividends. And ownership interest means an equity interest that carries rights to the profits, capital reserves of an entity determined as per the applicable acceptable financial standard. So nothing exciting here, and we will assume that there are 0 dividends to be adjusted. This is not necessarily true, but we'll make our calculation simple. The same we will do for equity gain and losses. Here's the definition. Excluded equity gain or loss means the gain included in the financial accounting profit arising from gains and losses from fair changes in value of the ownership. So if the ownership interest has changed and you book that in your accounts, you got to reverse that. Profit or loss in respect of ownership interest included under the equity method of accounting, except profit from a joint venture. So here's one exception, but if you normally book your participations to the net equity every year, you need to reverse that for purposes of Pillar 1, unless you're in a joint venture, because that is actually your profit from that joint venture for the year, I assume. And then you also need to ignore gains and losses from disposition of an ownership interest, so you need to add back or deduct those gains if you've added them to your income, and we will assume this is 0 as well. Then we get to policy disallowed expenses. They need to be added back, and in the case of Facebook, we will look at what happened here, but first the definition. Policy disallowed expenses mean expenses included in financial group for illegal payments, including bribes and kickbacks, so those cannot be deducted, and expenses for fines or penalties that equal or exceed 50,000 euros for a group entity. And then Facebook publishes this in their annual report. They say, they talk about the FTC, and they talk about, I think this is basically the issue with the British elections and the company to whom they've sold user data that showed how they could manipulate Facebook viewers to form certain opinions. And then it ends up saying, with among other matters, our settlement with the FTC required us to pay a penalty of 5 billion. So we will definitely add the 5 billion, 0.5 billion. We will definitely add the 5 billion to our add back numbers here. And then we have the rest of the adjustments. We'll assume that they are 0, and we will then look at a determination of the profit. Article 5 for purposes. The adjusted profit is a financial accounting profit after making the adjustments set out in paragraph 2, which we've just done, and deducting any net losses in accordance with paragraph 3. So now we need to look at paragraph 3. And it says that net losses constitute the total amount of cumulative financial accounting losses over the eligible prior periods after making the adjustments in paragraph 2, right? So paragraph 2 being the adjustments that we've just done. And then any losses transferred in an eligible business combination or eligible divisions. And there's a lot of text about how you do this. So if you merge or demerge a subsidiary within a covered group, the question is who gets the losses, and because you can only get them once, you can't get them twice, and it ends up with saying net losses are carried forward and deducted in chronological order. So as with most systems in most countries, you take the oldest losses first. An eligible prior period, we should just have a look at what does that mean. It means the earliest period in which there is an unused loss. So you go to the earliest period, provided that that is no more than 10 calendar years prior to the beginning of the period. So under Pillar 1, you can carry forward losses for a maximum of 10 years according to the definitions. And then there's also this issue of when Pillar 1 is introduced, and in that case you cannot carry forward losses from 10 years ago. You can only carry them forward from 3 years before Pillar 1 came into effect, and that's what paragraph 29A2 says, I believe. It says, but no more than 3, but begins or ends after the date, which was then the date of implementation, but no more than 3 calendar years prior to the date of implementation and 10 years prior to the beginning of the prior period. All periods, if any, between the eligible period and the current period are eligible periods. Makes sense. We will assume that there is 0 losses to be carried forward to keep this video relatively short. So let us now look at our formula further. We've got the allocation of profit, and we're trying to find P. And then we need to look at the determination of the adjusted profit before tax of the group. The adjusted profit is a financial profit after making adjustments set out in paragraph 2. So what have we learned from paragraph 2? We've said that the financial accounting profit was 29,146. That's what's in Facebook's accounts. We needed to add back the tax, which was 4 billion, and we needed to add back the disallowed expenses of 5 billion, and that gives us, we said net losses would be 0. Our adjusted profit before tax would then become 38,180 million. So this is the profit before we take off the 10% routine profit, right? We've got amount P figured out now. So let's move on and let's see what amount R is, the revenues of the group. And if you look at Title 7 and the definitions, it says revenues means the revenue of the reported consolidated financial statement of the group prepared in accordance with GAAP, subject to exclude revenues that relates to items excluded in Article 5, 2, B, and C. We just looked at those. Those are dividends and gains on participations. Exclude revenue from an excluded entity. We assume Facebook does not have that. Adjust for any prior periods and changes. We assume that those are 0, and adjust for revenues derived from a joint venture. We assume that we don't have that either. So we can now fill in the revenues as 85,965 million. And now we need to calculate L, right? The revenues of the covered group for a period that arise in Denmark pursuant to Article 4, in respect of which the Nexus test is met. Now we've done that already. Just have a quick look at the actual Nexus test as it is written in the proposed laws. It says the Nexus test is satisfied if revenues arising in a jurisdiction pursuant to Article 4 are equal to or greater than euro 1 million. For the purpose of paragraph 1, where the jurisdiction's domestic gross product for a period is less than 40 billion, the euro 1 million is replaced by 250,000 euros, right? But Denmark is definitely way above 40 billion, so we need to see whether Facebook earned more than 1 million in Denmark, and we've already looked at their turnover, and we saw that was 936 million kroners, which translates to $132 million, which is way above the 1 million euro Nexus test. Okay, so now we need to go and source the income of Facebook in Denmark, right? L is the amount of revenues of the covered group for a period that arise in Denmark pursuant to Article 4, in respect of which the Nexus test is met for Article 3. We've seen that the Nexus test is met. Now, what does the revenue sourcing rules say? And this is by far the most complex part of Pillar 1, is allocating income, right? So revenue sourcing rules say when revenues are treated as arising in a jurisdiction, revenues must be sourced in a manner that accounts for differences among jurisdictions in the goods sold and their quantities and prices, and revenues must be sourced according to the category of revenues earned. And now you get a breakdown of all kinds of categories, and then you need to allocate the income of Facebook into those categories, which I think is not going to be easy. If we look at paragraph 4, the covered group must source all revenues. Okay, revenues must be sourced using a reliable method. Obviously, you need to do that. And then revenues from the sale of finished goods sold to a final customer are treated as arising in a jurisdiction where the place of delivery of the finished goods to that final customer is, right? But Facebook did mention briefly saying doing some deliveries, but I'm not sure if that will be covered here. But that will be a part of a revenue that needs to be allocated, and maybe that is in Denmark, maybe it's not, I don't know. Then revenues derived from the sale of digital content treated as arising in accordance with paragraph 8F. We will look at 8F in a moment, and then revenues derived from a sale of components are treated as arising in a jurisdiction when the place of delivery of the final customer is in that jurisdiction, and again, not core business for Facebook. But now if we look at paragraph 8 and we just go through every point there, revenues from services shall be sourced as follows: location-specific services in the place of performance of the service. I don't know if you advertise, if you buy something to be advertised in Denmark, whether that means that the service is in Denmark, right? But then we also get 8B, advertising services is the location of the viewer of the advertisement. So that seems to me, I mean, if you know, this means that these revenues will be allocated to Denmark. Now, whether Facebook Denmark is doing that activity or whether that is done at a higher level, somewhere between Facebook Denmark and Facebook US, I don't know. Whether Facebook are engaged in online intermediation services, I also don't know, other than location-specific services. So online intermediation service, other than location-specific services. But this is to facilitate the sale of and the purchase of tangible goods. So 8C1 probably does not apply, but 8C2 says revenues derived from provision of online intermediation services that facilitate the sale or purchase of location-specific services are treated as such. Half of the revenue is in location of the purchaser, which one would assume would be Denmark, but if that is what the target is, and half of those is the place where the location-specific service is performed. Now, I don't know what you know. Does that mean that you need to buy a service on Facebook that is performed in Denmark? I'm not sure. I'm sure that Facebook is not providing transport services. I don't think they do customer reward programs. But they could do other services, and other services, the one that's referred to in paragraph 6, right? Revenues derived from the sale of digital content are treated as arising in accordance with paragraph 8F. And 8F says other services. One, revenues derived from provision of other services to which paragraphs A to E do not apply. We think, let's assume that they do not apply, are treated as arising in the jurisdiction when the place of service is in that jurisdiction. I think so far, I find if you really concentrate on each word in these location descriptions, I have a gut feeling that most of the income will be allocated to Denmark. Well, if you look at Facebook, Denmark's income, I don't know what other income would be allocated to Denmark, but I am not sure, right? And then if we look at paragraph 9, revenues from the licensing, sale, or alienation of intangible property, I think we can say does not apply in the case of Facebook, but 9b says revenues from the licensing, sale, or alienation of user data is treated as arising in jurisdiction when the location of the user is associated with that data is in that jurisdiction. So here we come to again our British case in selling voter data to political parties to influence the outcome of the elections. So maybe some of the Facebook services are falling under Article 4.9b. The allocation doesn't stop there. Just to have a quick reminder of the activities done by Facebook Denmark and Facebook in general, you can see here I've recapitulated what they are doing, and just adding the Danish revenue, which is 132 million. And then we need to also look at Schedule E, because that gives us detailed revenue sourcing rules, right? So Article 6 just gave us high-level sourcing rules, but Schedule E goes further and gives us the detailed many pages of revenue sourcing rules. And to come back to online advertising services, for instance, it says revenues derived from provision of online advertising services are treated as arising in jurisdiction when the location of the viewer is determined to be in that jurisdiction. And you do this by looking at paragraph 2, where the user profile of the information is saying that it's in that jurisdiction, or the geolocation of the device used by the viewer is in that location, or the IP address is in that location, right? And if you don't have any of that data, you can still look at other reliable factors or an alternative reliable indicator. So we can now allocate Facebook's advertising income based on that, if we believe that that advertising is what they do. When you sell user data, you have more or less the same criteria, because it says paragraph 1 to section 7 of Schedule E, revenues derived from sale of user data are treated as arising in jurisdiction when the location of the user that is subject of the data being transferred is in that jurisdiction, and then the location of the user is again determined by user profile, geolocation of its device, its IP address, etc., etc. So we will assume that for this example that the full $132 million are generated in Denmark, and that there is not more Facebook income to be allocated to Denmark. So now we can go and fill in our formula finally, right, and determine what Q is, the profit of the covered group allocated to Denmark, right? We start with, we already saw that the assumed profit P was 38,180 million, right? So we've got that number. We already know the Danish number, which is L, is the 132 million. And then we can do our calculation. We can say P minus R times 10% multiplied by 25%, but the Danish revenue over the covered group revenue translates to 38.1 billion minus 85 million multiplied by 10% equals 38 billion minus 88 million, as we already said. And that gives you 29.5 billion to be multiplied by that is the residual profit, right? So it's the profit, the 38 billion minus 10% of the turnover, which is the 8.5 billion. So it gives you 29.5 billion, and if we need to calculate a quarter of that, and then we need to multiply that by the Danish revenue over the group revenue, which is 0.15423%. So that brings us down to 7 billion times 0.1543%. And so the Q, the income to be allocated to Denmark in this formula, will be $11.5 million. We will stop our video here and continue with the calculations in the next video in the next few days. Bye for now.